Well, welcome to the Growing Money with Sean Trace podcast. I have an interesting guest with me today. Now, would you like to tell people who you are and a little bit about what you do?
My name's Victor Ricciardi. I'm considered a behavioral finance expert, but essentially I've been teaching college full-time at several different universities for the last 20 years. So
That's
I
awesome.
tend to focus on things like financial planning, investments, corporate finance, teaching intro to finance, and then my research area, and I integrate it within my teaching, is behavioral finance. So currently I'm a visiting faculty at Science College in right outside Philadelphia. Set my second year here, and
Awesome.
I currently have 3 books in behavioral finance, and my newest one is an advanced introduction to behavioral finance. So this is a cheaper one. So this is like what I'm excited about. This one is, the publishers typically determine the prices, so at least this is a reasonable one. The other two, if you're really interested in behavioral finance, are more like Bibles, but in there tend to be a little bit more professionals. But especially
Okay.
the first one 10 years ago, Investor Behavior, it's around $80, and it's actually still probably selling better now than it was 10 years ago. So
Really?
it takes time. I think, if you're not on my experience is if you're not on like the New York Times top list, it actually, once you start getting some good reviews on a book, I think that starts to help drive the popularity even years later. So, and the
Right.
research, there's always new research in every area, but the principles tend to be the same, I think.
Yeah, they do. Well, let me ask you this, because I would have to say that I'm actually a real newbie on behavioral finance. What is behavioral finance?
Behavioral finance is really just taking into account that when we make decisions, we're really human beings. So,
Mm.
for example, or even if any of your listeners have actually taken a psychology class.
Yeah.
So it's not that everybody's necessarily. There are episodes historically where people are crazy and you have panics in the market, but it's really understanding that we make our decisions not just based on numbers, which most quant finance is based on, but we're impacted by our past experiences, our emotions, and which may not be a bad thing, but it's just trying, I think, to understand when we are suffering from bad biases can have bad outcomes as well.
Yeah.
So, for example, the way I think about it is I understand my emotional triggers as an investor or as a decision maker, and I try to remove those by having a non-emotional strategy in place to help make better decisions. And that also then relates to something like financial planning and having goals. So if you have goals and you can make yourself think about short-term versus long-term objectives and what's important to you, I think all those things help us make better decisions.
Yeah, most definitely, because we would like this to think that we can operate inside of a box that is fully neutral and completely objective. But the reality is every single person comes in with their experiences and their backgrounds, and how did you grow up, and what were the stories that were told to you about money? What were the little the morals that were taught to you throughout your life about how to interact with money, and so for myself, I remember that money was taboo. Money was something that was not talked about in my family. And then it led to me just getting to adulthood and not having information enough to really make informed decisions. And and as I have become a father now, it again brings up for me like how my daughter's asking me questions about money, and I'm like, I need to figure out these answers so that I can, share with her and then also improve my own financial situation, because, and I think that for many people, we have, it's black and white. Are you good with money or bad with money? and it's much more nuanced than that. How you interact with money is way more nuanced than that. There was this funny video that I watched the other day, and not that I'm advocating playing the lottery all the time, but there was this interesting story about this guy from Australia that won he was in a coma. He came out of the coma and he went to the gas station and played a scratcher and won. And he won I think $100,000. And so they interviewed him on the news. And in the interview, they said, "We want you to reenact that. So go ahead and buy another ticket, scratch it off." And he scratched it off and he won $250,000 more. And he was cracking up. And I remember that there was, in the interview, he's like, "I've never been good with money. I've never had luck with money." And it was interesting because in that moment, forget the fact that there was just one of the most randomly lucky things ever. It was interesting to hear how he was starting to talk about how he interacted with money at that moment. He's like, "I never interacted with money in this way. I never had anything going my way." And I was like, all of that is some type of programming that he received when he was younger. However he was talking about money and the way he was speaking about it in general was, we don't always form our own opinions. It's all the stuff that gets fed to us and given to us. So it's interesting to start looking at that and unpacking, where did you get your biases from? Where did you, create your views on money? Does that make any sense?
Yeah, and just a couple of points. So, like you're talking about, those are known as in childhood as flashpoints. So you had maybe negative flashes. I had positive flashpoints.
Talk to me about that.
I started investing. My father was a hairdresser, just high school educated, but I said I had seen an investment, or like putting money in copper. So I invested in a copper company when I was age 12. And then I bought Coca-Cola. And then I bought all these blue chip stocks. And I probably had more money, if you put aside student loans, I had more money at 25 than most 50-year-olds had it. And now, and I went through all that money, and then I kind of realized in my 40s, let me apply everything I'm teaching now that I've learned, and I kind of re-accumulated all my wealth. And, I'm never going to be very, very rich, but I think it's really just making sure at this stage of my life that I have enough money for retirement. But also, when you're making decisions, don't look at social media. Yeah. Don't watch the financial news. Those are all things. And when I'm saying remove emotion, if you're truly a long-term investor, all this other stuff is noise. Even who's worried about going to be the next president is important to you, maybe politically, but it shouldn't impact necessarily your money decisions. Because if you're investing for 20 years, you're going to have Republicans and Republican presidents, and Congress will be controlled by others. So all that stuff to me is noise. And I don't want to trade because it drives up my stress level. It drives up my emotions. And so I have people who get frustrated with me where I like slow, stupid, and boring compared to the shiny red apple and the pulse and the trading. They don't realize it, though. And you try to talk them through this, and sometimes there's a lost cause. So, and if that's their thing, fine. But I also try not to push my beliefs on others, even when I'm teaching my students. Try to talk about what's the drawbacks and the advantages to everything. And I think that's extremely important when you are making these decisions. Nice. And it's not that, and we have to make these decisions. So you either embrace it or you're forced to make those decisions.
Yeah. That's so true. You either embrace it or you're forced to do it, one way or the other, you're going to do it. Now,
you got to pay medical bills, you got to pay rents,
Right. Can you share with me some common behavioral biases that beginners should be aware of when making financial decisions?
Yeah, so I would say some of them and you'll read an article and there are dozens of them, but it's really just some of the most proven ones. So things like overconfidence, We tend to be all overconfident, meaning that we think we can control outcomes. You ask somebody, for example, you ask everybody, you say to somebody, do you think you're an above average driver? The majority of people will say they are. So that's an example of overconfidence. So then if you ask somebody, do you expect to outperform the S&P 500 next year? A majority of people will say that. And that is overconfidence. And that leads to trading, herd mentality, and everything else. I mean, that's why a financial plan migrates that type of overconfidence by, if you're saving $2 million and from age 20, and that's your objective to have $2 million in retirement, and you want an 8% return, what the S&P 500 is doing is not the point.
Yeah.
Another major one is known as loss aversion, in which losses on the downside feel more painful than on the upside. And what that causes us to do is we hold on to losing investments or dogs too long, and then when something goes up, we sell it too quickly. And the reason that we don't want to sell it is we don't want to go through the pain of regret. So it's the same thing as like a consumer decision. You made a bad decision about something, and you don't want to admit to yourself that you made a bad decision. And then every decision isn't necessarily driven by emotion. It's driven by something called heuristics. And those are rules of thumbs that we use in how we process information. So if we had a bad experience buying a certain financial product, and then 5 years later, a financial advisor offers you that same product, you won't want to buy it. And so an example of that heuristic is an anchor. You anchor on that bad experience. And the same thing, whereas if you have a positive experience, that reflection point, then you put in, it's also what's known as representativeness. So let's say you bought an IPO and you made a lot of money. You then draw the conclusion that all IPOs are going to make money. And then the last one I say that's important on the bucket list is something called status quo bias or inertia. So the opposite of overconfidence is the idea, okay, we make a decision, we put money into a retirement account, but we never check on the account. We never see a financial advisor. And so we just let it ride. And so it's the same thing. We don't go to the doctor. Many of us don't go for an annual checkup. Well, you should first of all find a financial planner or advisor, and then you should have an annual phone call or in-person meeting with them, have a financial plan done, and that's another way how you overcome many of these biases. Because even when you have a financial plan, you have financial biases. So the first step is not all about the behavioral aspects of things. It's giving people the financial education and also the incentive to start to save and realize they should not be doing it alone. Having an advisor, I'm a financial expert. I still have a CPA doing my taxes because I know I can't be an expert in every branch of finance. And I sleep 100%. Better at night knowing my taxes are done correctly than ever getting a notice from the IRS. So it's either pay now or pay later. So there's nothing wrong with paying for good financial advice.
Yeah. Now, you had talked a little bit about the psychology of risk as well to me before we started recording. Now, why is understanding psychology of risk important for someone who's new to investing?
Well, especially if you're living through a period in which the market's going up, you don't even consider risk. But risk is when that asset declines in value, what are you going to do about it? So if you're overexposed, so for example, let's say you have an average risk tolerance, which risk tolerance is what is the maximum amount of or percentage that you're willing to allocate within your portfolio to say a stock. So let's say you put 60% in stocks, 40% bonds. Bonds is considered to be safer. Well, back to that status quo bias. If you just let the market ride, and let's say the market does really well, and that 60% stocks goes to 80% without making any adjustment and just selling off a piece, or what's known as rebalancing, you now become an aggressive risk taker. And then when the market corrects itself, because you're in too much volatility because you didn't adjust your portfolio, what is the risk that's going to happen? The risk is not just the downside of losing money, but the risk is when the market goes down and you are losing money, the trigger point is fear, and you're more likely to sell at the worst possible time. So the other relationship of risk is be like Warren Buffett, which is essentially buying on fear and selling on greed. And it's not selling on greed, it's taking money off the table and just reallocating it to a safer asset.
Interesting.
And again, so most people don't even know the asset allocation decision, but then if you're not monitoring it and you're not having an advisor, and most of this stuff can be, if you have a 401k plan, can be set up automatically once a year, but you have to have the knowledge, the incentive, the motivation, and the education to do all this. And the average person does not have this.
No.
I mean, I was watching the news today, it was CNBC, talking about the current head of the Social Security Administration was saying that 50% of retirees, their only income is from Social Security. So those 50% of the people have no exposure, or also maybe have no knowledge, or never save for retirement over their lifetime. And those are the people that really worry me. And that's why even my students, I don't talk about like saving for a retirement account. I call it a wealth account, because I'm a 55-year-old talking about retirement savings to a bunch of 20 and 22-year-olds. So I try to tell them this is going to help you with career, because maybe this is a career pursuit, but also I describe it as you're building wealth with tax advantage and other aspects. So a lot of it is also framing, and not, you want to think about long term, but you want to at least remove maybe the idea of telling a 20-year-old to save for retirement. As I said, describe it as a wealth account.
Yeah. Well, you touched on, and I wanted to ask about that a little bit more too, because it almost feels like you need to be a little bit like a bit of a Zen master sitting there and really in control of your urges and your emotions, because, fear and greed are very strong motivators to people want to eat the cookie and they don't want to have the cookie taken away, and yet, except if you're not kind of in control of that, like, you can get pushed around by the ebb and flow of the market and just your emotions. How do you tell people, or what are some practical tips for managing their emotions when they start feeling this way?
Well, especially because I teach the 20-year-olds, and I teach things like financial planning and personal finance and investments. I tell them to even just start off with, at age 22, their first job. Even if they're not crazy about it, contributing to a 401k plan or a retirement account right away, do 5%. But also, if that's considered long-term money, by putting money every month into the market, you use something called dollar cost averaging. And again, if you're a 20-year-old or a 35-year-old, and you're not, and that money, and that's what is the money for? That's back to that financial goal. If it's retirement money, what the market is doing on a daily basis or a yearly basis is really not that important. And I tell my students, they look at me like I'm crazy. I don't mind when the market goes down, because I'm getting a lower price or more shares when the price is lower. And then if you're investing in something like an income orientated or a dividend income orientated, say, mutual fund, you're getting more shares. Well, guess what? Over the lifetime, you're going to get a dividend. You're going to get a greater amount of dividend income from that investment. And what the dollar cost averaging does is, when on fear, you're buying at lower prices, but you're getting more shares. And then when the market's going up and you're in a bear market where there's a little bit of more greed at the end of that bull market, excuse me, you're getting less shares and you're paying a higher price. The dollar cost averaging over your lifetime gives you an average price. So you're not buying low all the time, you're not buying high, you just want to be average. And if you could be average and just do the basic things and invest throughout your lifetime, make some good investment choices, the time value of money shows you that you can be a multi-millionaire by the time you're 60s. But telling somebody to invest over 40 years is very complicated, or they can't picture that. But that's why if you get them started young, and I try to tell them is if you save 5% or to 10% of your income in your 20s throughout your lifetime, you'll have plenty of money for retirement. If you wait into your 40s and wait till your 40s, you probably have to save 25% of your income. And so just trying to get them to understand, the earlier they get started, the better. But also, if they have $100,000 by age 35, then that really starts their juices flowing. And then that, I think, once they get past those 8 to 10 years of just investing, and if they're investing in a good time when the market's growing, they start to enjoy investing and they start to build wealth. You can tell someone to build wealth until they actually experience it and see the results of it. Then that takes them to the next level as well.
And I think it was one of the things that you poked at. I mean, goodness gracious, everyone would love to be Warren Buffett. But at the same time, being remarkably average is also awesome. There was this story about a man in, I believe it was Brazil, and he was just planting seeds. He was replanting seeds. A little bit every day, he'd plant a couple seeds, a couple saplings. And over a period of 40 years, he brought a forest back to the area where he lived. And it was, the animal species returned. There was so much more life, and it was literally like he restored the jungle. Because every day, he invested in the world around him. And it just was such a great analogy for me of, this was not a remarkable person. There was nothing special about this guy except for his consistency. His consistency to constantly be planting seeds was what allowed this giant forest to grow. And, and when everyone asks, what is your superpower? He's like, well, I get up and I just plant a seed. That's it. I did the same thing every day. It's not that, fantastic. It's not that wild. But he was consistent. And that consistency allowed for remarkable growth. And I think that, it's so hard to teach people the value of consistency, until they start to see it. For my daughter, she's 8 now, and she's been playing piano for 2 years. And the first year was an awful experience. She hated it. She did not enjoy it. And I just would sit her down and say, we're going to spend 30 minutes just playing the piano, dun, 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 dun. And it was not pleasurable for her. It was monotonous. And we played some games. We tried to liven it up, but it was still just, she kept showing up. After a year, it started getting a little bit more interesting. She could start to play, even though it was quite rough, some of her favorite songs from her favorite shows, After 2 years, it started to get interesting. Now there was this flexibility in her ability to play. And she was starting to say, hang on, now that I've shown up, every day for 2 years, there's something happening. And she could start to see it. And so, sorry, my nose is itchy. So it's what you were saying. Like, as you start to see these results, you start to go, hang on, there's something here. But in the beginning, it's not easy. And it's, again, if you can have a financial advisor or someone who's just saying, you got to do this, or a professor who's telling you, this is important, start now, or a parent, whoever it might be, or yourself, just putting that note up on the board in front of you, set aside money today.
So what you're describing is practice. It's hard to lose weight. It's hard to diet. hard to exercise every day. Well, finance, putting a plan in action and dedicating some time to it is not. If it could be fun, and for me, finance is fun. I try to take that positive aspect. For some people, I understand it's not their priority or their thing. So it's trying to get them, for those people with certain personalities, is trying to get them excited about it, or at least addressing the problem. I described status quo bias as inertia, but also it's related to the ostrich effect. There are certain things and decisions that there are certain things that, especially financially, people don't want to make decisions about. So what do, they bury their heads in the sand.
Yeah,
like they're at the beach, like an ostrich.
Yes, it's so true. It's so true. And so, but that leads into my next question. Why is it important to start thinking about retirement early, even if you're just beginning your financial journey? Why is this so important?
Well, especially for 20-year-olds who are getting that first job, the government gives you wonderful incentives. So typically a 401k plan, and maybe a drawback of it is the selection of investments aren't great, but the tax benefits are extraordinary, especially what I would call a traditional 401k plan. Because again, the money that you contribute is on your gross amount. So if you're in let's say you're in a 24% tax bracket, 20% tax bracket, and that's not even just talking about federal. You add state to it, depending on the state level, you can save for every $1,000 that you put in. If you're in a 24% tax bracket, you save $240. So that extra $240 is not going to the government. That is going to your pocket, and that's money that gets invested. Also, any dividends, capital gains is tax deferred. But also, as even a bare minimum, if that company offers you what's known as matching, and in a time when many of us aren't getting significant raises, that's free money. So for every you put in $1,000, if they match 100%, that's $1,000 of free money. So, and the government again is giving those incentives, so you might as well take those incentives. And you can do beyond the matching, but as a minimum, especially someone in their 20s should at least be doing the matching portion.
Yeah,
and then. So once we get somebody into the retirement plan, it's making sure that every retirement plan at least comes with some kind of financial consultant. I wouldn't call them an actual planner, more of a retirement expert, but at least making a phone call or meeting with them in person to make sure you have a decent asset allocation, that you're putting your money in the right funds. And that's because that's another detriment that people don't do. Some people just open the account and they put in a money market fund. So making sure a 20-year-old should be putting the money majority into stock funds, for example. So and most people will just, because human resources cannot give out financial advice. They can explain the benefits. The employee has to take the next step and take that incentive. And that's what's so crazy about a lot of this is we're all expected to be portfolio managers, not portfolio managers. We have to be financial experts. And, when you had a traditional pension in the 70s, the company would make all these decisions. The craziest or the drawback of the 401k plan that saw in the early 1980s is that every individual retiree in some ways is expected to be a financial advisor. The legislation didn't allow this requirement for the advisor to just automatically, or the company, make those decisions any longer. Every tens of millions of Americans are now expected to make those decisions. So you got to get people into the retirement account. You got to get them to save something, but then they have to be willing to constantly save, but also they have to have a decent portfolio diversification or selection of mutual funds. So all these are, and it's not that it's so difficult, but if you have never had a personal finance class, if you're not, especially if you're not a business person, you have or any type of interest. If you don't have a family member, it's almost talking like a foreign language. And that's why the planner is helpful, or the advisor. And again, only about 25, I don't know what the current statistics are, but probably only about 25% of American households even use a planner or any type of advisor.
Well, and I think there's some of the psychology of it too, is because, you know, it can be overwhelming. And I think that, you know, it's overwhelming to talk to people about finance topics and to not know. We have a pet bunny for my daughter. She had got the bunny, and I have had lots of animals in my life, and we have lots of animals now. I personally I have geckos and snakes and bearded dragons because I grew up with reptiles. I like them. I understand them.
Okay.
And you feed them, they chill, and I keep them clean, and I love them. I got all of them in here, and they're cool. They're my little friends. Her bunny, I don't understand bunnies. And the bunny had a little bit of a skin issue. So we brought the vet in, and the vet told me there was a couple things I was doing wrong in its care. And I very much pride myself on that. And there was a moment where I was sitting there and I was like, wow, he didn't mean to judge me, but I felt judged. I felt embarrassed. I felt awful that I had made a mistake that caused me to be in this situation. And now I needed help fixing it. And it just felt overwhelming. And I didn't want to be there. And I didn't want to even talk about it, you know? But like the reality is that the problem wasn't going to fix itself. I wasn't going to get up to the other side of this, and I wasn't going to be able to help my poor little bunny unless I educated myself. And I know it's just a bunny, but it's still the same thing. People feel overwhelmed and they feel embarrassed talking to someone. What would you say to someone who feels overwhelmed or embarrassed? What kind of advice would you give them?
Well, I think it's like anything else, is taking small steps to at least getting started. So that's why even a 20-year-old starting off with a 401k plan, you don't have to meet with an advisor. You can meet with so typically every 401k plan with a company will have a custodian who kind of implements the retirement plan. So most of the time, those people don't work on commissions. And so they're kind of on salary. So at least they're a good starting point. The problem is they're not going to give you a full financial plan. So I would say starting to meet with them, ask how to get started, what would be some of my investments, and then meet with them a couple of times, like going to a new doctor. You're getting to know that person. Then, as you start to get married, you have kids, or even as you're getting into a career, maybe you have a lot of different consulting income, where you should definitely then have a CPA or a tax accountant. You start to look for, and like anything else, you look for referrals for a doctor. Look for referrals from friends of financial experts.
Yes.
And again, and if you meet with somebody and you don't feel that, the biggest thing that you can do is you can walk away. You're not obligated to buy a product like a car. You're not obligated to buy an appliance. You don't have, if you feel like your advisor is giving you high pressure sales, you can find another advisor, because there are a minority, very small people that are high pressure sales. That's not the person for you. You want to find somebody who's looking at the beginning portfolio, or even a younger financial planner that's your age. They may not have the experience, but they're starting out also. So you'll learn together with them. And then also, if you are younger, you want someone maybe in your age group or close to your age group, because they're going to live probably as long as you are. Like I even have an accountant for 20 years. He just retires, and now I had to find a new accountant. And that for me is because I trust my accountant so much. Having a new accountant, which is fine, but he recommended, so that accountant recommended somebody else that he is passing his clients off to. But it's still, it's still like a marriage. It's not marriage, right? But it's a deep relationship that you have when you find somebody. It's like, as a finance person, I hate taking my car in New York State, for example. In many states, you had to take your car in for inspection every year. I hate taking my car to a mechanic, but I have a mechanic that I trust. Yeah, and he's a nice guy, and he realizes, sometimes my bill is $40, sometimes it's $500 next year. But I feel at least he is being honest with me. Yeah. So you want to you have an advisor that you want to trust. So many of the same ways that we make decisions as consumers also are the same things that apply to investment behavior as well.
Well, I think that you hit the nail on the head with that, because there's so much that we get. Financial planners, doctors, and mechanics are the three things that I think are super, super difficult to really find a good match. You know, I when I was living in Los Angeles, I had the best mechanic, and he was a Toyota specialist, and he knew what he was doing. And if he told me I needed to fix something, I knew I needed to fix it, because he didn't mess around. And if I was coming in and go, you know what, I read this, I saw this on the internet, I need to fix this. He's like, dude, no, don't trust the internet. Don't listen to that. I'm telling you, you don't need to fix that, but you do need to fix this. And I was like, well, that's not expensive. It's not a big deal. He's like, no, if you don't fix this, it's going to cause this. So get in there, fix this. You know, and having studied medicine myself, I left medical school. I'm actually finishing part. I studied Eastern medicine, and I've actually been going back and finishing part of my degree, which is pretty cool. But one of the things that I see is that I'm not a match for every patient that walks through that door. You know, and there are people that I don't click with. There are people that I do. And the people that I do click with, granted, I would love to help everyone, but you got to find the person that's the right match for you. You got to find the person that you can really feel and trust. And that, like you said, you don't need to feel obligated to go and say, yes, we are going to work together forever. Talk to people, get to know them, get to meet them, you know? And one of the things that I was looking, excuse me, I was looking for people to come on to this podcast. And one of the places that I was looking for people was on Yelp. And it was interesting to see, you know, there were some really honest reviews, and some people were getting raving reviews, and some people were getting kind of destroyed on there. And I mean, not that, but I think not that it's destroyed, but it's just, my wife loves a flavor of ice cream that I can't stand. And, you know, and my favorite flavor of ice cream is not one that she likes. And everyone has their own flavors that they like. And you got to find people that are the flavor that you're looking for, if that makes sense.
Yeah, I mean, even, you know, I've been teaching for 25 years, and I get student evaluations. And
Yep.
all I can try to tell my students is I show up every day. I will give them my full dedication. I have a certain teaching style, which does not connect with every student.
100%.
But as long as they're motivated, they'll at least learn something.
Yeah.
And, you know, I have a core group of students, you know, so if I have 25 students in a class and 18 have taken me before, I know I can't be that bad of a guy.
There you go.
Do I have a few students that aren't crazy about my teaching? But it's not even always the teaching. It's I don't take it personally, but I sometimes realize there's something else going on, especially even during the pandemic. You know, if they're stressed about something, if they don't like a topic area, they're not going to, you know, if they have to take an intro to finance class with me, and because they're a business major and they're not going to finance, they're not going to be crazy about who the teacher is no matter what.
Yeah.
So that's one thing. But I would say if you're looking for a financial planner, for example, go to the Financial Planning Association has a directory of all types of planners. You know, you can search by state and everything else. And then I'll even put things like, if you only have a little amount of money, you can see if you're starting out, maybe that's the advisor for you. There'll be other advisors that say there's a commercial I see that says you got to have at least $500,000 to invest with us. That's not for somebody starting out. That's not the type of advisor you want. And then once you think you find an advisor, FINRA is essentially a self-police. It's not a government agency, but they're a private nonprofit that. It's not perfect, but they set standards and regulate different types of advisors and planners. So if you go to FINRA.org, they have the directory, and it's not foolproof, but there are also other government websites at this as well, that you can check on the background of the advisor as well. And what you're looking for then is, do they have the credentials that they say they? So if they are a certified financial planner, they should have a CFP. It should be listed on there. But also, if there's any misdemeanors, any complaints from clients, any actions that have been negative towards them, they should be listed on there as well. Yep. Because if you ever watch something like American Greed, there are unfortunately people who do Ponzi schemes still, so you should try to check the background of somebody. And that's developing trust. But also, I think of an advisor as a portfolio. I typically will not give more than 10-20% of my money to any particular individual in terms of assets under management. So that's another way to control your risk as well. You can share what you own in different accounts, but you don't necessarily have to hold all your money with that particular firm and a particular advisor.
That's great advice.
So those are all just things that, I have tons of mutual funds, but then also I have money, because my retirement money is not with an advisor. And so even when I don't like, sometimes an advisor may pressure somebody once they have retired to move all their 401k plan to another advisor. I'm not keen on that. And so those are where I worry about high fees and things like that. But checking the background, using references, and checking out that FINRA directory are all good ways of finding the right person, but also making sure you don't get the wrong person.
Right.
I mean, if you look at Bernie Madoff on FINRA, you'll see all the things that he has been convicted of.
Yeah, that's wild.
And that's just basic financial knowledge. A lot of people wouldn't even know that.
I didn't. See, and that's why I'm talking to people, that they can find this out.
Yes.
So, how can understanding behavioral finance help someone make better financial decisions in their everyday life?
Well, as I said, looking for a non-emotional strategy. So, for example, I'm actually taking coursework in financial therapy as well. But the way I think about it is, so I break this up into two pieces. Let's go back to overconfidence. Let's say you're a planner, and you have a client who you believe is or is exhibiting an overconfidence bias.
Yeah.
And the way you see that is because they're trading their securities too much. Okay. They're moving their money around too much. So a coach might be just, as an advisor, you educate with financial literacy, explaining to your client that you should not be going in and out of stocks because you're trading then. It's more like gambling and speculation. And let's say that you meet with a client and they stop doing that after a year. So you solve the problem. That's just basic coaching. A therapist would be more of a financial therapist, or a financial therapy situation would be is the person can, even after you spoke to them, they educated them, they can't prevent their behavior. So something like financial therapy is something like compulsive gambling. I'm sure you see like those hoarding shows. Yeah. And so those are much more deeper psychological issues that, as I said, my background's in finance, accounting, and economics. I took on the psychology and all this other stuff later on, but I don't feel comfortable necessarily teaching like financial therapy. So especially an advisor, there's actually an American Financial Therapy Association that started in around 2008, and they actually have started a certification. So just like if a planner feels comfortable with it, they can actually refer somebody to a financial therapist.
That's so interesting.
But it's like anything else. People can't stop spending. Some people can't because of credit. They take on more and more credit card debt. That could be the issue of related to money or emulating their parents, but it could be a non-money issue. It could be something that happened in their childhood, and they are acting out with money.
Yeah.
So for me, that would be somebody that probably a typical advisor wouldn't know how to deal with.
It's so interesting.
But if they're going for help and trying to search for that, I think they just need guidance to find the right, in that case, they need a therapist and somebody to help them just get their financial situation straightened out.
It's so interesting. Well, could you give me an example of a behavioral finance concept that has helped you personally, or someone you've advised?
Um, I would say for myself would be, I'm old enough where I've gone through three bubbles, which is the internet bubble of the late 1990s, the internet bubble of the going into the financial crisis, and then even the pandemic. Yeah. So in my 20s, I was what's known as traditional finance, which is rational decisions. Mm-hmm. We don't suffer from these emotions. And I used to trade. I used to lose margin. So all that money that I saved as a 12-year-old, I lost most of it trading a margin once the bubble burst in the internet stocks. So I felt the pain. So actually feeling the pain of loss of money woke me up to, I got to do things differently. And so I started to save money into 2008. And I realized that it was a good buying opportunity. But guess what? I couldn't buy because I still had the baggage from the internet bubble. And so then in 2010, up to around the COVID period when the market was taking that big correction, I bought low. But then also and I'm not buying and selling a whole portfolio. I'm just buying. I had money in cash, and I moved in. And then once it recovered, I sold a little bit. So understanding that what a bubble situation was, and Vernon Smith, a Nobel Prize winner who specializes in bubbles, actually shows that it takes people about 3 bubbles before they actually learn their lesson. Really? And the way I look at it is it's the way to really change behavior. That's why you can tell somebody, you can have someone who made money in cryptocurrency for the last 5 years. And if they're trading and they're making money, me trying to tell them about long-term investing, it's not going to happen. But if they happen to lose in a 6-month period, if they lost all their gains, they felt that pain, then they may come back to long-term investing. So that loss aversion relates to the idea of feeling the pain. I even do this with my students when I teach the intro class. I could tell them that this is the most difficult intro class they ever taken in college. Half of them won't listen to me. I'll have 20 students. 8 of them will get D's and F's. I'll make the exam worth a lot less, because what will happen is they'll fail an exam. Half of the 8 that failed it will get 20 points higher because they felt the pain of failing the exam. So I changed the behavior and improved their performance, because even though I was telling them, just like our parents, until you actually experience something, some people will not change their behavior.
There was this story that I remember reading about, or this old adage. It comes from Chinese medicine, and it says, one health problem, or small health problem. I think it said long life. No health problems, so short life. Because it was this interesting thing that people that have a minor problem earlier in their life start taking care of themselves. They start to recognize that they are not invincible and that you need to exercise and you need to do that. But people who never had a problem are like clipping along until they just suddenly have a heart attack, and they're just like, wow, they didn't think that it could happen to them. And it's really wise to start sitting there going, thinking for the future, thinking ahead, and start planning that stuff out, start planning and taking better care of your overall situation.
Yeah, I mean, even I tell my students, I say, think about 10 goals. They can be intermediate, short-term, and long-term. Write those things down. Also, research shows when we write something down, we're more likely to achieve the goal. But then also, as you said, people feel overwhelmed. Don't start off with 10 goals. You have them down. Pick 1 or 2 that you think are most important and start working on them. I find it very difficult to diet and exercise at the same time. So I typically try to do one or the other. If I'm successful for about 2 months, then I add the next thing to my repertoire.
That's awesome.
So that's why for me, because I love I'm Italian American. I love my pasta and my pizza.
Yeah.
And so, but as I've gotten older, I realized that I can still eat it. I just have to eat less of it and less often, and I try to treat myself.
Yeah. Enjoy it. You enjoy it, and you still can have it, but you just gotta be aware of what it is, and love it for what it is. If you could go back in time and give some advice to your younger self, what would be the advice that you'd give to your younger self?
I would have told myself to avoid that internet bubble of the 1990s and to really apply, and again, I wish I knew now what I know about mutual funds, about risk perception, and everything else. That I wish I knew more about that in my 20s, even though you have finance degrees. There, also, I am old enough where now I'm talking to my students about financial planners.
Yeah.
Late 80s into 1990s, the financial planning profession was still very in its infancy. So a lot of the things that even if I wanted to tell myself, knowledge-wise, weren't even on my radar. Right. So the lesson is you know what you know because that's the information you have at the time. And, even myself, I paid off, so from 2010 to 2018, I paid off nearly $200,000 in student loan debt because I got tired of looking at it. Right. And now that I paid that off, I am, and I know talking about student loan forgiveness and all this other stuff, but not having that debt on my back, and so rather than making that monthly payment for my student loan payments, all that money is now available for me. Yeah.
No, that you're speaking to the choir, because I'm still carrying mine, and I still have a large amount due to having gone to graduate school, and it hurts. It really hurts, and I'm about that range right now. So the idea of being able to not have to carry that, I feel you. And granted, not even getting to the topic of student loan forgiveness, but just getting rid of that, getting out from under that, must feel amazing. So having that goal for me is You're speaking to the choir on that.
Yeah, because I ran the numbers. I could have paid it off to $869, but even though I had a low interest rate, there was so much of it. I saved about $80,000 in interest paying it off early.
There you go.
So, you're talking about credit cards with the minimum payment. If you're just doing the minimum payment on a student loan, even if it's only at like 4 or 5%, but if the amount is so big, there's still a great deal of interest that's accruing on.
Yes, it is.
And so, and unfortunately, even especially like, I try to tell my students, especially putting aside from student loan forgiveness, but in general bankruptcy for people, student loans in general are not dischargeable.
Yep.
So, that's why I even trying to tell my students, if you're going to sign for student loans, take the minimum that you need. Don't take extra that they're going to offer you. Yeah,
right. Well, this has been a masterclass. I really appreciate this tonight, and I want to say thank you for coming on. I'd love to have you back. Yeah. Where can people find out more? Oh, sorry. Where can people find out about your book? And where can they find you?
It's that all 3 books are on Amazon. So if you just search Amazon by my name, Victor Ricciardi, you'll find it. Also, I've been doing redoing my website for a long time, so it's not currently up. So my biggest presence is on X, formerly Twitter. So I have 68,000 followers. So and I don't. My agenda is, as a professor, is I'm not selling a product. I maybe promote some of my own research, but I try to just post even personal finance just to help people with financial literacy.
That's awesome.
So that's why I just, that's my agenda, is knowing that people are reading my books, don't make much money in terms of royalties, but just knowing people are learning about finance, that it helps them make better decisions, improves their life, then at least I know I've done something well.
That's awesome. Yeah, but that's all. That's the best thing you can ask for, man, is that you're making somebody's life better. So I appreciate that, and definitely for any other people out there, go and check out these awesome books. And again, thank you for coming on. I appreciate it.
Thanks for having me.